Good morning and welcome to the WITAN Investment Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to James Hart, Investment Director. Good morning to you, sir.
Good morning, and thank you to everyone for joining this morning. I'm aware that there will clearly be a mixture of levels of knowledge on WITAN Investment Trust, so I'll start by giving a sort of high-level introduction to the company and what it is that we try to achieve before going into a bit further detail before opening after our short presentation for Q&A, and we'll take questions as they come in. WITAN Investment Trust. I was looking back at our history the other day, and as it says here right in the middle of this slide, the company was founded in 1909 as an investment company listed on the London Stock Exchange, and as one of the largest investment companies in the country. We're a member of the FTSE 250, which makes us, with assets of well over £1 billion, one of the largest and most liquid of all investment companies, and it is almost exactly 100 years since we were listed on the London Stock Exchange. 1924 was the date of our listing. But what is it that we try to achieve? We're a one-stop shop for global equity investment. We're one of the few independent self-managed investment trusts, which means that my colleagues and I are employed by WITAN rather than by a third-party fund manager. We believe that perfectly aligns the interests of the board of WITAN, the employees of WITAN, and indeed our shareholders. Our shareholders, of course, are our employers. So we're perfectly aligned there with our shareholders. So over the course of that 100 and something year history, WITAN has evolved. We initially started out managing the assets of one family, and then those assets were invested across the world in infrastructure, in railroads, in telecoms and communications. And over the years, our portfolio has evolved to be a global equity investment portfolio. In 2004, the decision was made to move from having a single manager managing our portfolio to adopting a multi-manager strategy. So that means that the board and the investment team look to identify some of the greatest fund managers around the world, and we allocate bits of our portfolio to those managers based on the opportunity that we see at the time, and indeed focusing on what is their special edge that they could add for WITAN shareholders. Importantly, it's important to understand that WITAN is not a fund of funds. We are a multi-manager investment company, and that means that rather than allocating assets to the funds run by our third-party managers, they manage money on our behalf, held in our own account. So in other words, we have full visibility of what they're doing with our money. We can see all the trades that they're putting through our portfolio. It means that we can't be gated, for example, if something happens at one of those fund managers. That means that they as obviously happened with the Woodford case a few years ago, that those funds get gated and investors can't take their money out. That doesn't happen to us. So we have full control over our assets. We have full visibility. It gives us huge insight into the way in which our managers are thinking and behaving. And so we believe that that's a very advantageous structure for our shareholders. But what is it that we try to achieve? We're managing an actively managed global equity portfolio that looks to deliver long-term growth in capital and income for our shareholders over the long run. So this is the structure of WITAN. We have a board of directors in place who look after the interests of our shareholders. They're the ones who set the strategy and indeed ensure that the strategy that they have set is implemented. We have regular board meetings throughout the year in which not only obviously all the directors attend, but also members of the investment team and also the operations team here at WITAN. Our job is to oversee the day-to-day implementation of the investment strategy, as well as to advise on the selection of managers. And I say advise on the selection of managers because we're inherently involved in the manager selection, but also it is down to the board to make the final decision on which managers are appointed. We have a selection of portfolio managers, currently 8 portfolio managers running different parts of the portfolio. And as the box here on the top right-hand side of the slide says, we look for various types of attributes, not only within ourselves and within WITAN itself, but also within our external managers. We look for talented individuals and teams, people who are able to construct high conviction portfolios that are sometimes quite concentrated in terms of the investment style or themes that they're looking to benefit from. Sometimes those managers can be adaptable, so that they read the investment environment as they see it and adapt their portfolios to suit that environment. Other managers are much more constrained in the way that they manage money, and they don't change from year to year. We obviously look for experienced individuals who have a long track record of delivering superior returns for their investors and their shareholders. And also we look for people who have an independence of thought, independence of spirit, and largely also sit within companies where they have pretty much the ultimate say in the direction of those businesses. In other words, their investment style and their investment strategy is absolutely aligned with the outcomes that they deliver for their investors. So when we put all that together, we end up with a portfolio that is what WITAN shareholders are invested in. It's approximately 1.7 billion sterling currently, invested in about 250 companies across the world, and those are spread across 60 different industries. So as you can see, very well diversified in terms of company exposure and in terms of exposure to different industries. Spread also across 33 different countries. Now, obviously, the lion's share of WITAN's portfolio is invested in a handful of countries, but it is invested across 33 different countries around the world. And you might think that, well, that's a hugely diversified portfolio, and therefore, perhaps very similar to equity indices or benchmarks that we're looking to outperform. Well, in fact, because we have managers who have very high conviction portfolios, their portfolios look quite different from the benchmarks that they're looking to outperform. And so when we put them all together, we end up with a portfolio that has very high active share. Now, active share is a measure of how different a portfolio is from the index or benchmark that it's looking to outperform. And the number here is 79% for WITAN's portfolio. And just to explain that, a number of 0 would mean that it's an index tracking portfolio, so identical to the benchmark that it's looking to outperform, and a number of 100 is completely different from the benchmark. So you can see here 79% is quite different from the benchmark. So we believe that our managers are all earning a seat at the table in the attempt to outperform the benchmarks that we've been set. So just taking a pause, we think about WITAN's portfolio in 2 distinct buckets. And the reason we think about it like this is because we believe that there are two distinct investment parts of the equity investment universe. So our core portfolio, which is approximately 75% of WITAN's assets, is run by 6 different fund managers. And as it says here, they look to buy high quality companies throughout the world, but typically in developed markets. They look to identify companies with enduring cash flows or underappreciated growth prospects, or indeed undervalued and sometimes cyclical businesses. But they each approach the investment world in a slightly different way. And that's one of the key jobs for the investment team at WITAN is to ensure that we have the correct balance of management styles, so that our core portfolio delivers a broad yet diverse exposure to global equities. So, for example, the names on this list here, some of which you will obviously recognise. Lindsell Train, for example, runs a portfolio of global equities with enduring franchises and high quality businesses. Jennison is a US-based manager based on the northeast coast of the US. They specialise in identifying very high growth companies where the growth rates of the earnings within those companies are inflecting positively. So they're high growth companies where growth is accelerating. WCM is another name that you might not recognize. They're based on the west coast of the US. They look for high quality businesses, growth companies, where the barrier to entry or the barrier to competition, or in other words, the moat, which using term coined to describe how defensively positioned a company is, where that moat is expanding. So in other words, a company isn't standing still, it's continuing to build up competitive barriers against competition. So those are just a flavor of some of the managers that we have in our core portfolio. I'm very happy to answer questions on them individually or collectively as we get later on in the presentation. Now, obviously, there are parts of the investment world that aren't covered by large or mid-cap developed market companies. And so that's where our specialist portfolio comes in. It's roughly 25% of assets. It's allocated towards managers or investment opportunities that we see as having the potential to deliver superior long-term growth. They might be a bit more volatile, but with the potential to deliver superior long-term growth. And these include areas such as emerging markets. We have an investment in a climate change strategy, which we see as a good long-term investment theme, providing long-term growth rates for our shareholders long into the future. And we also invest via funds and investment companies into areas such as private equity and life sciences. Again, I can go into a bit more detail on those, and very happy to answer questions in the Q&A. So what does this give shareholders in terms of typical investments? So here we can see some examples of companies that sit within the core portfolio. I'm sure that virtually all of the names on display there will be recognizable to you all. I don't want to dwell and identify any particular company at this stage, but as obviously as you can see, there's a mixture of companies there, from some of the technology and internet giants like Google and Microsoft and Nvidia, to some more cyclical or value opportunities like BP and even NatWest Group, which despite having a bit of a hiccup last week with earnings falling shy of expectations, has delivered returns ahead of benchmark over the last couple of years. And then in the specialist portfolio, a bit more esoteric, as you can see there. One of the big names is TSMC, Taiwan Semiconductor Manufacturing Corporation, which is the world's largest semiconductor foundry. But then Vestas Wind Systems, there's one or two solar technology businesses that sits within our climate change strategy. And we also have exposure to life sciences and emerging market names. Sorry, my mouse just got stuck there. So looking at the portfolio in a different way, breakdown by geography, sector, and investment style. The lion's share of the portfolio, as I mentioned at the start, is in developed markets, with the majority in North America, Europe, and the UK, and then a smattering of holdings across Asia. Sector split is pretty evenly spread across the major sectors. And in terms of companies by style, now I'd like to warn here that I believe that value and growth, or we believe that value and growth are convenient shorthand terms, but don't necessarily represent the true attributes of an investment company or of an investee company. But as you can see, they're roughly split between growth and value opportunities. You'll also see from these pie charts that there's a segment that says investment companies across the three of them. Now, these are investments that we have made into listed investment companies, which do things that are specialist, and we believe will give us beneficial long-term returns. So it's probably worth just pausing and having a look at that segment of the portfolio. If I can move on a page. Here we go. So this is the investment company portfolio that WITAN has. It's approximately ranges between 10 to 15% of assets. It's just shy of 15% at the moment. And it's broadly invested across three main themes, plus one or two other opportunities. The majority of the portfolio is invested in private equity. And as you can see there, the major holdings are listed investment companies, Apax Global Alpha, Princess Private Equity, and HarbourVest. Now, one of the things that's been going on over the last year or two is that the investment company sector has suffered from a widening of discounts to net asset value. And so as you can see here, I've put in a column showing the current discount to net asset value of our holdings within investment companies. And a very rough average is about 30% discount to net asset value. And so we believe that buying into long-term growth opportunities like private equity, like life sciences, often at a deep discount to net asset value, provides shareholders with not only the ability to benefit from long-term NAV growth, but also a narrowing of the discount over time. So it's hoped that you get a sort of double whammy in terms of the potential to produce outsized returns from this part of the portfolio. Other names that are probably worth highlighting at this stage are within the life sciences portfolio. We have a holding in a company called Syncona, which founds and backs early stage companies developing drugs and other treatments that are there to meet unmet needs, and they've been successful in launching and indeed subsequently selling a handful of such companies over the years. And we also have an investment in within the infrastructure space, a company called VH Global Sustainable Energy Opportunities, which looks to build out small to medium-sized sustainable energy companies that address different parts of the world. So there's a hydro plant in Brazil. There's a fuel treatment plant on the US-Mexican border, as well as a solar and battery storage plant in Australia. Again, I can come back and answer questions as they arise on this part of the portfolio, or indeed on any part of the portfolio as we move through. So moving on to what else we can do to help generate returns. Obviously, the returns generated by the portfolio are the key to long-term investment success. But as an investment company, we have other levers that we can pull to try to deliver beneficial returns to shareholders. So we've used gearing for a long time. We believe it's one of the great advantages of the investment company structure. As you can, but we apply gearing, which we believe is appropriate for current market conditions. We tend to have more gearing when we believe that equities are cheap, and less when they are looking expensive, as opposed to trying to time our level of gearing on sort of the kind of short-term measures. So it tends to be in place for the longer-term outlook. As an investment company, we have this wonderful advantage of being able to have fixed rate long-term debt. And in fact, we over the last 5 or 10 years have issued quite a significant amount of fixed rate debt that we used to provide the majority of our gearing. The average coupon on that debt is 3%, and it's dated out to 2054, so ranging between 2034 and 2054, with an average interest rate of 3%. So if in effect we're borrowing money at significantly cheaper rates than the UK government, and we can use that to deploy into equity markets to help generate additional returns. But what we also want is the ability to be flexible. So we have short-term variable rate debt as well that we can use to alter gearing over time. We also have the ability to buy back our own shares, and we have done quite significantly, as well as issued shares in previous years, so that we can help to dampen the volatility of our own discount, as well as provide an uplift to shareholders who remain invested in the company. So every share that we buy back at a 10% discount to asset value provides an NAV uplift to those shareholders who remain. It is our long-term policy or aim for our shares to trade at a sustainable low discount or even a premium to asset value. And we will be continually active in buying shares back while our discount remains wider than we would like. And it's currently around about 9%. So we believe that's a very attractive level at which we buy our own shares back. Other things that we can do to help generate returns and to sometimes reduce risk is to use ETFs and very occasionally index futures. It says derivatives there, but we only ever use index futures. And that can help to tilt our asset allocation if we feel that the portfolio characteristics that is the result of our manager stock selection, whether if it would be beneficial to tilt that allocation a little bit. We also have a progressive dividend policy. I mentioned I was looking back at the history of WITAN when I started talking this morning. In 1974, WITAN raised its dividend, and it's raised its dividend for every year since 1974. So the policy that the board follows is that they want to continue to raise the WITAN's dividend every year, and over the long term ahead of inflation. Now, obviously, it won't be that we're able to raise the dividend ahead of inflation every year. Recent history being a case in point. But we do look to raise a dividend every year. And as you can see here, we have a history of 48 years of consecutive dividend increases, which is the pink line. And you can see the green line there is the dividend payout history of the FTSE All Share. So much, not only was it less significant in terms of absolute dividend growth, but also there are periods of significant setback. For example, during COVID, where many FTSE companies cut their dividends. So that's one of the advantages of A, having a diversified portfolio, B, having a portfolio of quality businesses, and C, being an investment company that allows us to retain some of our earnings from previous years and put them into a revenue reserve to be able to subsidize dividend payments in years where there is a shortfall. As you can see, the current yield on our ordinary shares is 2.6%, and we have delivered just over 8% dividend growth over the last decade. Just a brief coverage of our responsible investment policy. Now, obviously, if we're looking to invest into companies that have sustainable cash flows, that are high quality businesses, this sits hand in hand with investing responsibly and ensuring that our managers are investing in companies that have predictable long-term cash flows. And as part of that, we engage with our managers to make sure that they're engaging with their investee companies if anything goes on at those companies that might be detrimental to long-term cash flows. So that doesn't just mean ensuring the governance is up to scratch, but of course that is one thing that they do look at. It also involves and we've identified a couple of the key drivers here: climate change and the change in social expectations. Now, obviously, the transition to net zero provides not only an investment opportunity for those companies that are well placed to benefit financially from the transition to net zero, it also imposes a risk on those companies that are ill placed or at the wrong end of the transition. So that's something that we look at with our managers to ensure that that they're addressing those issues within the portfolio. But also the other side of things is the change in social expectations. Companies that don't behave well, companies which have questionable supply chains, that don't treat their staff well, where they have high staff turnover, all those sorts of things are going to be detrimental to long-term earnings for companies. So again, we engage with our managers to make sure that they are engaging with investee companies to make sure that best practice is in place so that they don't run or fall foul of poor practices within the workspace. And that's one of the advantages of having a multi-manager structure rather than a fund of funds, is we can see how managers are responding to changing events within their portfolios. And indeed, we can see what we own on every single day. So if there is a controversy at an investee company, then we can engage with the manager responsible for that company to see what they're doing about that holding. Sorry, I've got another. There we go. Slides were sticking there for a second. And this is really what our responsible investment policy means to us, set out here in terms of the 4 key tenets of our policy. So we believe that prosperity for us as shareholders comes from owning companies with sustainable cash flows, and those companies are exhibiting good corporate behavior. They engage with their stakeholders, and they have respect for their shareholders. People, those companies are run by strong and experienced managers, where they are have an inclusive and diverse culture, and also have respect, importantly, for not only their customers, but their employees, their value chain, and indeed the communities in which they operate. The planet, we want companies to be looking to minimize their own environmental impact, or where they are, and this is crucial actually to one of the investment opportunities, where they're positioned to help accelerate the energy transition, because we think that's a very long-term growth opportunity for companies that are able to benefit from the transition to net zero. And finally, partnership, where companies are open to collaboration, where they're open to engagement with us as shareholders, and importantly, where they're open to acknowledging mistakes that they've made in the past and looking to address those issues to move forward. So we're not necessarily looking for companies that are already as pure as the driven snow, but we are looking for companies that are prepared to make improvements over time. And I'm going to end at this part of the presentation just to restate our purpose, and our purpose is to achieve significant growth in our investors' wealth over time. Obviously, running quite an actively managed portfolio, that's not a straight line, and to be able to achieve significant growth in absolute terms as well as relative to the benchmark, we need to be positioned differently from the benchmark, which will mean that at times we'll outperform and at times we'll underperform. But over the long run, we're hopeful that the strategy that we have in place will continue to deliver significant growth for our shareholders over the long run. And with that, I will pause and I think open to questions.
Perfect, James. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while James takes a few minutes to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. James, as you can see, we received a number of questions throughout today's presentation, and if I could just hand back to you just to read out those questions and give responses where it is appropriate to do so, I'll pick up from you at the end.
Absolutely. Well, I'll take them in. I was going to say I'll take them in no particular order, but I will. I'll take them in the order in which they're submitted. So the first question here comes from on the subject of share buybacks, and the question is: every trading day over the last 3 years, you've bought back shares. Do you ever see a day where you'll not have to buy back shares? And do you see a day when the company becomes too small to be viable, and how small will that be? So the question is absolutely right. We have been buying back shares pretty much every day over the last few years. And in fact, we've bought back shares every year, I think for the last 7 years. And before that, we issued shares at a premium to asset value. So as you can, it is a two-way street. Hopefully, we will be in a position again in the not too distant future to be able to issue shares, but that relies on our own shares trading at a premium to asset value, and partly that relies on a change in the balance of supply and demand dynamics, not only for WITAN itself, but also for the investment company sector, which in general is trading on quite a significant discount to asset value, having reached nearly par with NAV. The investment company sector is now trading at close to an 18% discount to asset value. So that's quite a broad industry dynamic. What I would say is, yes, we bought back shares every day. We think it's beneficial to our shareholders. I mentioned earlier that the remaining shareholders receive an uplift to the value of their net asset value when we buy shares back, and that runs into tens of millions of pounds worth of uplift over the last few years. In terms of the quantum of shares we buy back, it's varied between kind of 1 or 2% to up to about 8 or 9 or 10% in individual years. The average is approximately 5 or 6% over the last since we last issued shares. The average number of shares we bought back is about 5 or 6% over the years subsequent to that. So I mean, that's not dissimilar to the kind of returns you get from global equity markets, which obviously have delivered 6-7% annualized over the long run. So in effect, what we're doing is, yes, we're buying shares back, but we're using money that is generated from investment gains, so that the company isn't shrinking dramatically. Do we ever feel that the company will become too small to be viable? Not in the foreseeable future is the answer to that question. The next question is a bit more specific, and it's about how do I get a valuation on my WITAN ISA investment? I'm going to assume, and if the questioner wants to contact us directly, by all means do, and I'll give you information on how to do that in a minute. But I'm going to assume that the questioner had perhaps had an investment that was held in a WITAN savings scheme. The savings scheme was closed in 2019, and shareholders were given the opportunity to elect to have their shares moved to a different provider. And those that didn't elect to move to a different provider were moved onto the Hargreaves Lansdown platform. But the questioner only the questioner will know whether that's the case or not. I suggest that if you email us at contact@witan.co.uk, we can look into the history of your holding in WITAN, provided it was held on our in our savings scheme, and be able to give you specific guidance on that. But so I'm afraid that's all I can say on that. If you want to follow up, please do so. Questions come in saying, could you comment on your charges, as it appears that the AMC for WITAN is significantly higher than that for Alliance Trust, also a fund using a range of investment managers in a similar way to WITAN? Yeah, this is an interesting topic. I can't speak for Alliance Trust, but I don't believe that our ongoing charges ratio, which is the sort of purest the purest explanation of charges, is that different between the two companies. The way our ongoing charges ratio is broken down is roughly, and these are very rough numbers, because we don't charge a management fee at WITAN. We're employees of the company, but the management fees that we pay to external managers is roughly 50 basis points. And then the costs of running WITAN on top of that, including administration and operations and marketing and salaries of the 6 employees and indeed of the directors works out about another 30 basis points. So our ongoing charges is just shy or around about 80 basis points, which is slightly higher than I think than some of our competitors, but not materially so. And then you come into quite a thorny subject, which is far too detailed to go into to very detailed explanation here. But when we look at the key information document, there are other costs that are put into that document that are the costs of running an investment company, as well as the same as running an operating company. So, for example, the interest that we pay on borrowings that we invest in the market, that obviously over the long run are generating positive returns for shareholders, they're displayed as a cost rather than they're displayed as as part of the charges, where in fact they're really a cost for managing the portfolio. And indeed, our investment company holdings are also we kind of publish a look-through cost of the management fees paid to those companies, but obviously the performance that we generate from those holdings is net of all costs. So I can't give you the exact number because I don't know what the number is for Alliance Trust, but that should help, because that should help explain the difference between the two. Next question. You said your aim is long-term increase in capital and income. This is not the same as long-term total return, because you probably feel an obligation to increase your dividend year on year, whereas pure total return can ignore this. How much has your total return been reduced by your dividend considerations? The short answer to that question is we're total return investors, and therefore we look to appoint managers, and they look to buy companies that are going to produce the best possible total return over the long run. Now, that might be in the form of capital return. Indeed, a manager like Jennison has very few companies that pay any kind of significant dividends, whereas others might look for greater value opportunities where companies might be distributing both dividends and share buybacks at a rate that's a significant premium to the market. I think it's important to point out that we don't strive for income's sake. We're very happy to own companies that are going to grow their dividends over time, but a high starting yield is not something that we are chasing. And in fact, our own yield of 2.6%, I would argue, is not a significant yield target to have. So no, absolutely, we're looking for total return rather than being constrained by the need or desire to pay an increased dividend each year. Next question. I note that only 18% of the portfolio is invested in the UK. There's a lot of talk about the competitive position for the UK market and how companies are listing internationally. What's your view, and does the current impact on valuations provide an opportunity to increase your weighting in the UK? Interesting question. I mean, yes, absolutely. The UK market is, we believe, one of the most attractively valued markets in the world at the moment. 18% is is actually pretty much in line with the 18% weight the UK has within our own bespoke benchmark. Just to explain, the way WITAN's benchmark is configured is that it's 85% MSCI World, All Company World Index, and 15% UK. There's 3% of the UK in the World Index, so therefore the UK represents about 18% of our benchmark. So the number of 18%, which is roughly in line with the benchmark, but obviously that's quite a significant that's quite a big weighting in the UK versus global equity benchmark. So we're pretty happy with with 18% as a weighting in the UK. It's been a bit of a headwind for WITAN over the last few years. Since Brexit, investing in the UK has been a pretty lonely place, and particularly where you have 5 or 6 or 7 companies, all of them domiciled in the US, really leading market returns from over the last few years. That's been a headwind, but we think that there's a lot of interesting opportunities within the UK market. But we would leave it down to our managers really to decide whether they want to put more of their portfolios in the UK or not. And all of our core managers, it really does range quite significantly. 1 or 2 of them have virtually no UK exposure. On the other end of the scale, Lansdowne Partners, who run a global equity portfolio for us, have 40% of their portfolio invested in the UK market, which gives us a lot of that exposure within the 18% number. And in fact, we're about to, I believe we're about to publish a video of an interview that I carried out with the manager of the Lansdowne portfolio, Pete Davis, explaining what he saw as the opportunities within the UK market. So anyone on the call here who would like to see that interview and see the explanation of the opportunities in the UK market can visit our website, where the video should be up in the next day or 2. How is your performance compared against your peer group? The peer group's quite wide, and all approaches investment in different ways. Over the relatively short term, so this year to date, and indeed over the last 12 months or so, I believe that we are kind of there or thereabouts versus our peers, and in fact probably in the top half in terms of performance versus our peers. Over the long run, I think we're also there or thereabouts. We had a couple of more difficult or more challenging periods. One was around the time of COVID, where we were positioned for economic expansion and economic growth, and of course we got the absolute opposite. And more recently, as the interest rate cycle started to tick up, that was a challenging period for a couple of our managers. So that sort of medium-term performance, the 3 to 5 years, has been a bit more challenged, but short-term and longer-term things have been there or thereabouts versus the peer group. But obviously that changes day to day, so it's more difficult to identify exactly over the short term how things are progressing. Would you ever consider changing the weighting of your core versus specialist portfolio? Yes, absolutely. I mean, one of the things that we said, that I started out by saying at the beginning, was that some of our managers were adaptable, and that also applies to WITAN itself. WITAN has evolved over the last 100 plus years, and I believe that we should continue to evolve, to continue to make ourselves continue to be relevant to shareholders, and indeed to potential shareholders. There are no plans to do anything in the short term. I mean, what might happen is that the makeup of the core portfolio or the specialist portfolio might evolve, so that as we see different opportunities, I think there are tremendous opportunities within the investment company sector. As I said, discounts have widened out dramatically, and there are some very good quality investment companies on offer at quite significant discounts to asset value. So I could see that would be something that we might want to take advantage of over the months and years ahead. But fundamentally, I don't see that the kind of top-down allocation 75-25 will vary considerably over the near future. I think it's worth bearing in mind that we see WITAN as a one-stop shop for global equity investment. WITAN does form a cornerstone investment for many shareholders, and one of the reasons why we put in place the core and specialist allocations was really in response to what we saw as the ideal balance between exposure to some of the world's largest and greatest companies, and some of the more nascent opportunities that sit within the specialist portfolio. So we're happy with it as it is, but there's no reason why that can't change over time. And obviously, if it was to change over time, we would be, we would make that clear to shareholders. And what is the thinking behind the split? Well, I think I've sort of basically answered that one. There are great opportunities within large global businesses, but the opportunities are also there available in more specialist opportunities, and we feel that that's the right balance between the potential opportunities of higher growth companies and higher growth sectors versus the obvious risks of owning companies that sit outside the developed markets or outside some of the more mature investment themes, where, for example, in life sciences, you can be invested in a company that has 10 different underlying drugs under development, and one or two of them will hopefully come through and work in the near term. Others might be 3, 4, 5 years away from approval, and some might fail. And so there is a balance to be struck between the risk and potential opportunities available both in the specialist and the core portfolios.
Perfect, and thank you very much. I think you've addressed all those questions from investors, and of course the company will review all the questions submitted today and will publish those responses out on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, James, could I just ask you for a few closing comments?
Yeah, absolutely. See if I can just move the slide on here. I mentioned that the investment company sector has suffered a derating in the last couple of years, and this chart here shows WITAN's discount as shown over the last decade. And this kind of slightly goes back to the question about buying shares back. You can see that in the periods 2014, 2015, we were trading at a premium to asset value and therefore able to issue shares. Really, since over the last couple of years, the discount has widened, and we've continued to buy shares back. But we believe that it's a great opportunity for the company to buy its own shares at a discount to asset value. And in the same way, for investors looking to get exposure to global equities, our own discount, which is at close to 10%, is an opportunity to get exposure. Effectively, you're buying £1 worth of assets for 90p. So there is potentially a valuation opportunity there for those for whom WITAN would suit as an investment in any case. But I think really I want to just finish on our outlook, because I haven't spoken much about how we're thinking about the global equity market and how we're thinking about the state of global economies. I mean, this year has really been a year where sort of failed to deliver some of the optimism that was considered to be out there or considered to be likely for 2023. China was supposed to be reopening and produce a boost to global economic growth, and obviously the reopening of China has been a bit lackluster, let's say, a bit disappointing. But in a way, that's a positive, because actually one of the main things that's been a concern this year is inflation. And if China had reopened with an enormous bang, and there have been huge demand coming from China, then that might have pushed central banks to be even more aggressive than they have been. So in a way, what we're thinking about now is we're very much at a period where inflation has peaked and is indeed starting to subside. Interest rates are close to, or if not at, a peak, but we don't think they're going to come down super quickly. So higher for longer is probably the right way to be thinking about this. Or as we wrote in our annual report at the end of last year, the peak in interest rates, it should look more like Table Mountain than the Matterhorn. And then really looking forward to next year, this is where we can envisage a period of sustained economic growth as interest rates peak, as inflation subsides, as central banks become less hawkish, potentially as Chinese stimulus kicks in, and as but it is worth bearing in mind, of course, that there are two major conflicts in the world at the moment, and so energy and geopolitical concerns are certainly unpredictable. So this is still an environment where it's important to be a long-term investor, where one should be an active stock picker rather than perhaps an index tracker, so that you're able to avoid the pitfalls that might be in the road ahead. But lots of opportunity, we believe, for long-term investors to be invested in equities, provided you're in it for the long run.
Perfect. James, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of WITAN Investment Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you very much.